Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Advanced Charting Techniques. And today is a little bit of a viewer request, but we're going to be taking a look at a technique for analyzing charts that was introduced 130 years ago as of this year. It's known as Dow Theory. We're going to be discussing whether Dow Theory still has a role for traders in a modern analytical marketplace. And I think for some it does. That's a bit of a spoiler alert, but we're going to talk about what the theory is, how there's been a bit of an attempt to modernize that theory. We're going to be applying it to current market conditions. Really good discussion ahead. I think there's a lot to learn for just about everybody. Before we can get to any of that, though, let me first of all say hello to everybody who's chatting in out there in YouTube. Great to see all the familiar names. Great to see anybody here who is might be new. But hello there, JV Texan, Jay Richardson, Will, Tatiana, Jeffrey, Jill, Scott, Chena, Grace, everybody else. Eva, thanks for joining us, everybody. We appreciate your attendance and your contributions to these discussions week after week. And if you are among those that are here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, enjoy that recording. That's a great way to watch these videos. But be aware that you're invited to join us in the live stream if you'd like to be here in that live stream audience. This is a Friday webcast series, and we kick things off promptly at 1 Eastern time. Now, I also want to let my live stream audience members know that my very good friend Kevin Horner is hanging out in the chats with us. Kevin and I have been working together for years. Kevin, thanks for having my back here, but Kevin's going to be hanging out there watching for any questions that come in. If I can't get to those questions, Kevin's going to be there to pick up my slack. Kevin and I would also like to issue an invitation to everybody listening to follow your favorite Schwab presenters on social media. You can find Kevin and me on X. So you can find Kevin on X, give him a follow there at Kevin Horner CS. You can find and follow me on X at Cameron May CS. Now, as of very recently, you can also follow me on LinkedIn. Just go to linkedin.com/in and then /Cameron May CS. But let's get into this discussion talking about Dow Theory today. What is it? Can it be applied to modern market conditions, and how might that be done? But as we do, of course, any approach to investing or trading carries risk, so bear this important information in mind. This material is intended for general informational and educational purposes only. Schwab does not recommend the use of technical analysis as a sole means of investment research, and investing involves risks, including the loss of principal. All right. So here's what we're going to be doing today. Yes, we're talking about Dow Theory, but the very first thing that we're going to do is have a look at our current example trades. So we have 3 positions in our paper money portfolio. We'll just do a quick review of those, see if there's anything that might need to be done with them. Then we're going to look at the markets. And I will take a peek at the S&P 500 through our TVM strategy set lens, but then we're going to switch our discussion over to how might a Dow theorist view what's going on with stocks today. So we're going to spend the rest of our time talking about Dow Theory, what it is, how it might be applied to the markets, and we're actually going to still plan in place a new trade within the context of that Dow Theory backdrop. So this is going to be an interesting discussion. Let's get right to the Thinkorswim desktop. This is the paper money software platform. So here are our 3 current positions, starting with Advanced Micro Devices. This is I think, just getting off the ground. We'll see if this trade does well in the future, but this position was taken last week. Now, this one was taken on the evidence of a rising exponential moving average of 50 above the 200. So sort of an intermediate exponential moving average above a longer term. That might be a trend confirmation for our trader here. But the entry timing came down to what was going on with what's known as the disparity index. How far is there some disparity of current price relative to sort of average prices over a prescribed time frame? And what we saw on the index is we got to a relatively extreme low, and we started to rise again. If you happen to miss this discussion or the other discussions that we've had about other technical tools that I'm going to be talking about today, you can play catch up here. The vast majority of our webcasts are recorded and then added as playlists to the archives on our Trader Talks channel on YouTube. So first of all, do yourself a favor. If you haven't subscribed to our channel, do that. pop down below the video, click on the subscribe button. It only takes a second. It doesn't cost anything. But our Trader Talks channel on YouTube is where you can join our live streams like this one right now. You can also find the playlists. So if I were to click on playlists and scroll a little bit beyond halfway down, we'll see right here is my Advanced Charting Techniques series archives. And I can just click on view full playlist below that. And we can see right there, trading short-term stock extremes with the disparity index. So that's what we're talking about. Our other indicators used for the construction and planning of our other example trades we can find in the previous archives. But let's go back here. Here's what's going on with our disparity index trade. We purchased as that started to rise from an extreme low. That was right here. And price has kind of gone up. It's pulled back a little bit. We're slightly above water for that trade. We do have a stop in place right down below. Well, it's actually right down at the 200 period moving average at this point. It's kind of snugged itself up there. And then we have a target up here at previous highs. So we're going to let that one continue to work. McKesson, though, is very different technically. Let's load up our McKesson study set. This was our zigzag high-low indicator trade, and we've been waiting for a while. Bought when we zigged. We've been waiting for a zag, and guess what we have right now? Yep, prices are pulling back. We've moved our stop up, and this was a small position. In this webcast series, we used to take little tiny example trades. We've expanded that to get more of our example portfolio invested, or at least working. In any case, we've moved our stop up, and yesterday, we got close, almost hit that stop. You can see how vital stop positioning can be to retaining ownership of shares if that ongoing ownership is a priority, right? Using very tight stops can lead to more whipsaw events. In this case, we got close, but price recovered. Still strengthening, but we do have that exit signal. So I'm going to close out the McKesson position. Let's come here. I'm going to, if we can go up here to the working orders, or we can operate right here from the sell button. But here's our McKesson trade. This is our, pardon me, our stop. We're about to close this out, so let's cancel that stop order. Now, let's exit the position. We're going to right click, create a closing order, and sell those shares. And I think for today, in the interest of getting this filled as quickly as we can, let's put in a market order. Now, this is displaying a current market price of $934.16. A market order is not a guarantee that that's what we'll get. There's certainly risks in putting in market orders, but let's click confirm and send. And those risks can actually be even stronger if we're dealing with an illiquid security. McKesson tends to be more heavily traded. Couple 100,000 shares already traded today. We're dealing with 6. Anyway, there's no commission here, but there can be on some types of trades. Let's send that order off, and we're out of McKesson. So that's now a small, because of the small position sizing, realized gain on McKesson. Now moving on to Walmart, that's our final trade. Let's load up our strategy set here. And this was a bull flag trade with a VWAP potential enhancement of timing of the entry. Again, you can go back to the archives and see the logic of this entry. But we saw what appeared to be a bull flag here, took an entry on a breakout, had an initial stop down below that flag, and we raced up to a target. Now, we didn't have an automated exit there. Instead, here, as price passed through that target, we moved our stop up. Now, since then, we've come back down. Note over the last week, we were up here last week. We've pulled back down. This looks like it may have started to establish itself as a new support level. That's what we were hoping for. And we're starting to move higher again. Now, for some technicians, they may look at the passing of new highs. So from just a week ago, we've gone above new highs. That's interesting. Kind of Dow theory in action, just as a little bit of a spoiler alert, but on a much shorter time scale, which he would have objected to, by the way. Anyway, how about we move our stop up to just below these recent highs. So shall we move that up to, let's say, 130? Let's just grab that stop and push it on up, get it as close to 130 as we can. How about we leave it just a shade below 130? And let's cancel and replace that stop order. Quick reminder that stop orders are not a guarantee that we will sell at a specific price level. There's no commission on this stop order if it gets triggered, but let's send that off. And then we've moved that stop up, and we'll keep following that. But I'm going to leave that one in play. And let's now move to what's going on with the market. So that's our current positions with each of those. If you want to see the technical logic of the trade, you can go back and check out the archives. But let's have a look at what's going on with the S&P 500. So this is going to be one technical perspective of the markets in general, but then we're going to use a very different approach when we look at this through the lens of Dow theory. So let's switch up here. We're going to switch our strategy set to our TVM, our trend value momentum strategy set, which we use as a lens for what appears to be going on with the S&P 500 each week. Eric says, if you traded off camera, would you have sold after the breakout of MCK? I don't like to, it's a good, legitimate question, but speculating about what one might have done, especially when you ask what I specifically would have done, I don't get into how I manage my positions. It's outside the role of my portfolio, of my role as an educator. Here's the danger that I run into. If I were to say, let me tell you how I would have managed this trade, to my audience, that sounds like, well, if that's the way Cameron did it, maybe I should do it that way too. And that's inappropriate. I'm not an advisor. I don't offer advice. I offer education. And talking about my own trading or my own approach to the management of my portfolio, yeah, it steps right through those lines that are defined pretty clearly for me in my professional role. So it's a good question. I just can't talk about what I do. All right. So back to what's going on with the S&P 500. Doesn't mean we can't talk about trading in general or about concepts of trading or how they might be typically applied. It just means I can't get personal about it. Yeah, find your own path, Willie says. Yep. All right, so what's happening with trend, with value as measured by RSI, and with momentum as measured by the MACD? Well, the 50-period exponential, I'm thinking back on our last strategy set, the 100-period triangular moving average is still rising above the 200. I'm just getting everything goofed up. Pardon me. The 50 triangular, it's still above the 100 triangular. But for those that use this strategy set as an approach to planning a trade, that might be a bullish confirmation of ongoing trend strength on the S&P 500. And I don't think that surprises anybody, given that we're maybe 1% below all-time highs on the S&P, something like that. But yeah, trend appears to be intact. And interestingly enough, the S&P, as it pulled back, seems to have once again settled just above that 100 triangular moving average. So that might be something a trader might keep an eye on. Next up is our value indicator. In the short term, sometimes a trader will look for prices to reach relative extremes. Maybe they do that like on the disparity index. Maybe they use a different oscillator like the RSI. But in this case, we note that the RSI did dip below 40 recently and started to climb again. This information is going to be pertinent to the way that we place our trade. I'm actually going to place an equity or a stock trade using this strategy set. So it's not always just for a review of market indices, might also be used in the planning of a stock trade. Yeah, Eric, okay. Yeah, no, that's legit. Should have phrased it differently, interested from an educational perspective. Yeah, well, and let me summarize that. So you see what I do on camera, but as I've said before, I don't make any changes to the portfolio in between my webcasts because I want you to see the logic of the trade as it's happening. Plus, I think it can be a little bit disingenuous if one is trying to pump up one's numbers or the appearance of their performance. They might go back over the week and say, ooh, this would have been great if I were a really good trader. I would have gotten out right at this moment. There's no temptation for me for that because I don't do any trading when the camera's not on for these webcasts. You get to see the plan for the trade. and then do it with me in real time. So is it possible that a trader might have gotten out at a different time? Yes. Maybe I'll talk about that in a future webcast because I think that's a valid question. But in the interest of time, I'm going to move this discussion forward, leave enough time for our Dow theory discussion. Okay, but value, that might be a check for the bulls here. So we got a check from trend, a check from value. We're low and potentially rising. Momentum is kind of trying to decide what it wants to do. It looked like we had a bullish shift in momentum moving from bright red to dark red, and then we've kind of slipped back to dark red territory. So that might be a minor check for the bears. But overall, what do we think? Let's bottom line it. Probably still net bullish from this technical perspective. But that's not the only way that traders or investors might get a gauge of what's happening with stocks and the trends of stocks for a long time, going all the way back to 1896. Some traders, some investors have used an approach to trend analysis of stocks known as Dow theory. So let's talk about Dow theory. What is it? First of all, who's Dow? Yes, it's that Dow. It's Charles H. Dow, the co-founder of Dow Jones and Company, the creator of the Dow Jones Industrials Average, and importantly, the Dow Jones Transportation Average. But Charles Dow, back in 1896, wrote a series of articles for the Wall Street Journal in which he proposed his view of how someone might keep their eye on major developments in price movements of stocks. So what he first of all had to do was figure out a way to broadly track stocks, and he selected the approach known as the index known as the Dow Jones Industrial Average. And then he described general movements, patterns in movement within those groups of stocks. But he constructed his theory based on 6 primary tenets, T-E-N-E-T-S, okay? So here are these 6 tenets of Dow theory. Now, as I get into these, how many of you are familiar with Dow theory? I know it's been around for a long time. Doesn't mean everybody knows it. Certainly doesn't mean everybody applies it. But who's familiar? Just a quick yes or no. Are you familiar with Dow theory or not? And I will say, if you're familiar with, let's say, looking for highs and lows on a stock chart, you're leaning at least somewhat on the groundwork that was laid by Charles Dow 130 years ago. Jonathan says it's new to me. Basan says just heard of it. Lawrence is saying he's not familiar. Okay, well, let me write out the 6 tenets of Dow theory, and then we'll explore them each individually. So first of all, market discounts everything. Number 2, some of you might recognize that. Some people might have heard of the random walk theory, that the market's already aware of everything that you can make yourself aware of. There are 3 general market trends. Let me get this out of the way. Number 3, there are the primary trends. It's one of the 3 trends. Have 3 phases. Number 4, transports must confirm. I'll tell you what that means. Number 5, volume must confirm. And number 6, an assumption about trend. Trends persist until clear reversal. And you know what I'm going to do, since this is sort of always in the eye of the beholder, let's put clear in parentheses. There we go. Let's open that up so we can kind of fit it all on one line. And let's go through these 6 tenets of Dow theory one at a time. First of all, what does market discounts everything mean? It just means that to Charles Dow, looking at the chart was all one had to do. Now, I'm not going to make the case that that's accurate. As a matter of fact, we put a disclosure right at the start of every webcast that Schwab does not recommend using technical analysis as a sole approach to investing. But in any case, Charles Dow says the markets are already aware of all the news that we can go spend our time looking for. Now, another thing that we want to keep, that we do want to be aware of is that Charles Dow operated in a very different marketplace. The communication of news, the time frame from the development of news, the dispersal of that news to a wide audience, and the application of that news to the trading of securities, that was one time frame back in 1896. How quickly does news spread and how quickly is action taken on news today? It happens very quickly, right? Tempted to say instantaneously, but obviously not in every case. But that's what Charles Dow means by the market discounts everything. Is if we go do a bunch of research to learn about a company or learn about what's going on with the markets, everybody else is already aware of that, or at least enough people are that it's already been absorbed into price activity and the price has already moved. So there may not be value, theoretically, in doing that. Number two, though, is that the market tends to move in trends. So now we're shifting our focus right to the charts. So let me go to the chart that Charles Dow was talking about. But back in 1896, this chart didn't even exist. It was just 30 companies that someone would have to make a manual ledger of and track their movements on a daily basis. But we now know that as the Dow Jones Industrial Average. And I'm going to clean up my chart. Let me take off our study set. Let's just remove all the studies and do some Dow theory here, all right? But there are three general market trends. So Charles Dow described those as a primary trend, a secondary trend, and then what he called a minor trend. Primary trend is a trend extending for a year or longer. So we're looking at just a 1 year chart here. In order to do really traditional Dow theory, I need to go to a longer time frame. So how about we switch this up to a 3-year chart? This is the big advantage that we have now. Charles Dow, even himself, the creator of this theory, didn't have. We can just bring up a chart. All right. So let's look at a 3-year chart. So there are primary trends, which tend to go over a year. There are secondary trends, which typically happen over a period of weeks to months. And then there are what he called minor trends. And he was very deliberate with the phrasing of minor. He actually referred to minor trends also as noise. That's the day-to-day, just maybe up to week activity. To him, that was kind of noise. But let me just show you how he might have, and I can't ever climb into the head of Charles Dow, but a typical modern approach to the application of Dow theory. One additional change I'm going to make to my chart is that Charles Dow thought intraday activity, open, high, low, that sort of the movement of prices within a single day was just additional noise or static. So a common modernization of his theory, well, and this was his theory, he only used closing prices. So we don't need candles for Dow theory. Instead, we're going to change our chart style to a line chart, just using closing values. So now let's look at those three market trends. These are just some examples, but this might be an example of a primary trend. So as we look back at the fact that this is a 130-year-old approach to the markets, is there, at least at a conceptual level, the potential for application to current market conditions? Well, I think that there could be, yeah. But a primary trend is identified by looking for highs, cyclical highs and cyclical lows over at least a 1-year time frame. And so as we're looking at this 3-year chart, we'll notice that the Dow has had a tendency to run up to cyclical peaks and pull back to cyclical troughs. Those are the terms that Charles Dow would have used rather than highs and lows. He would have said peaks and troughs. But Dow suggested that the investor or the trader look at on each sequential peak or trough, was the most recent peak higher than the one before, and was the most recent trough higher than the one before. If we have a combination of at least one higher peak and one higher trough, that's defined by Charles Dow as an upward trend in a primary time frame. So whether we call it peaks or troughs or highs and lows, I think this is actually fairly familiar to a lot of modern technicians. So the primary trend was the primary driver of Dow theory. Now within these primary trends, there were similar peaks and troughs that happened on a shorter time frame, typically happening over the course of just a few weeks to a few months. And so let me bring up a secondary view of the Dow. So we're still looking at peaks and troughs. We're looking to see, are those peaks going lower or are those peaks going higher? Are those troughs going lower or are those troughs going higher? But this is known as a secondary trend existing within a primary trend, and primary trend is commonly constructed of secondary trends. So we're starting to accrue technical evidence, either an argument for bullishness or an argument for bearishness for our would-be investor or trader who might be trying to decide whether to buy new positions. Should we go all in on new positions? Should we scale down those positions or just hit the pause button entirely? Now, even within the secondary trends, Charles Dow said there were these minor trends, otherwise known as noise or static. So that might look something like this. This sort of day-to-day, week-to-week activity, to Charles Dow, he says, ignore it. Okay, I'm just saying what Charles Dow said. I'm not saying that's my opinion, that this is an educational discussion. But those are the three market trends, and I think you can see, do they potentially have application to even today's market, or modern view of the markets? Could have. Now, within primary trends, Charles Dow said, and these are the big ones, these are the ones stretching over the years, Charles Dow said that there were three phases. Now, there can be primary bullish trends. There can also be primary bearish trends. Bullish trends can extend for years. Bearish trends can extend for years, although that's not actually terribly typical. Usually a bearish trend is like a couple of years or less, although it can certainly go longer than that. But within a bullish trend, Charles Dow said there's an accumulation phase, there's a participation phase, and then there's what he calls an excess phase. So here's what that might look like, and actually volume might help us with that. Let me bring up our primary trend again, and I'm going to add volume to the chart. So let's go up here to our chart settings, and under equities, we can show that volume subgraph. So let's click apply and click OK. And Charles Dow noted, and actually, even if I go to a longer term time frame, let's go to a 5-year chart, we'll notice that over the course of a couple of years here, this actually was about 18 months. That's not terribly unusual for a bearish primary trend. We were looking at a series of lower peaks and troughs, transitioning as we're moving into 2022 to higher peaks and troughs, and then we finally really settle into a primary bull trend here. And so Dow describes a primary trend consisting of three phases. Number one is that accumulation phase where the trend first starts to emerge. In his view, this is primarily driven by institutional or experienced investors. And as that trend starts to build, volume can start to build. That actually was a requirement of Charles Dow's model. Now, the second phase of that trend is still a continuation of bullishness, tends to be on more sustained volume, but this is where the we might call it the average investor or the retail investor starts to really commit funds to this apparently emerging bullish market. It's when people start to feel a little bit more confident, probably. So the institutions, the experienced investors, this is according to his theory, are already in. The less experienced investors are just sort of attracted to the excitement and they start to contribute. And then we're ready for phase 3. Now, time will tell if we're already at the end of an upward move. According to Dow theory, through at least this one lens, maybe we're somewhere short of the excess period. Why do you think you would call it excess? Well, that's when the bullish trend enters its possible final phase, where the buying continues, but on lighter volume, and the more experienced investors and the institutions start to phase out. So those are the three phases. In a bearish trend, I'm not going to spend much time on that, but he typically, instead of describing it as accumulation, he described that initial phase as distribution. Generally, the big investors taking positions out. The participation is the second phase, but then instead of calling the final phase excess, he called it panic. All right. So where might we sit? Well, again, this may be right or wrong. It's just one view of things, but this looks like it might fit into more of the model of the current apparent primary bullish trend as being in the Dow theory, maybe the participation phase in the bullish trend. Now, here's an important element. So there's our three phases. Charles Dow said this was our fourth tenet of Dow theory, and that is that transports need to be doing what industrials are doing. The industrials are supposed to be a gauge of the general health of the economy in Charles Dow's view, but what he wanted to see was that the transportation companies were also seeing their share prices going up. Now, back in 1896, transportation basically meant railroads. But the theory there being, if the economy is strong and if stocks are strong, then the companies that are transporting all of the goods of all of these other companies that are doing so well, those transportation companies, they should be benefiting from the overall strength. On the other hand, if industrial stocks are strengthening, but transportation stocks are weakening, maybe they're just not getting as many orders, and maybe there's some underlying weakness to the markets that aren't otherwise obvious in just a trend analysis of stock price. Or if transports are strong, but industrials are weakening, maybe the softening of orders of stuff is right around the corner. And so what we need to see from a Dow theory is a confirmation of transports and industrials going up. Wiley, moving product is exactly right. So how can we look at that on a chart? Well, there's an index there are actually several. The one that I'll use today is SOX. That's going to be our symbol. Let's add a comparison chart. So I'm going to go up here to our edit studies. We're going to do a comparison of the industrials to the transports. So let's choose the comparison tool. And this is going to default to a line chart, but I do want to change a couple of things here. We're not going to compare the industrials to the S&P 500. Instead, we're going to compare them to the transports. So let's change that to $DJT and click OK. Click Apply. So what this does is it brings up a line chart with the green and red line. Those are our industrials, and the purple line is our transports. One other thing that we might want to do here, let's change up our chart settings. And I'm going to go to the the price axis, and I'm going to make two changes. First of all, I'm going to show the change in price for both of these to make them sort of a fair comparison to percentage changes. And then I'm going to disable that left axis. So let's click Apply, click OK. What you'll notice then is we wind up with this. Now we have two lines that both converge at the start of our time frame. Let's switch this to maybe a shorter term. Let's do not truly short term, but let's go to a 3-year chart again so that we can get a closer view. One other thing that I'll probably do, let's change our scale here. I'm going to right click and drag, not right click, just click and drag this margin over here, and I'm going to zoom in. So using the price axis settings, I'm going to change this to auto, let's change it to manual, and that allows us to do a manual zoom. Click, drag upward. There we go. Zoom in on that, just so we can get a closer view of industrials and transports. So what Charles Dow might have proposed is that if the primary trend of industrials is going up, but transports isn't, that might be a sign of weakness that's otherwise not apparent in that trend. Right now, it looks like the two are confirming. Transports are starting to soften a little bit, even though industrials are strengthening. That might be something that traders keep an eye on, but not terribly closely, according to traditional Dow theory. Now, there's been there's been Chuck, did I lose you a little bit on comparing? I made some adjustments to the transport versus industrials chart. You don't have to, but if you want to revisit how I did that, just go to the archive of this webcast after we're done, and you can see the adjustments that I made there. It's not entirely necessary. We could just use the comparison chart, put in the DJT, the $DJT symbol. That's good enough, probably. In any case, there has been an attempt at modernization here, though. For some investors who use Dow theory, they say comparing industrials and transportation is too old-fashioned. Now, this is just an argument, but there's a new way that stuff moves around the world. It's not just the movement of goods, but more recently, the movement of information may be more important to some. So a modernization of the Dow theory of trends is, instead of looking at industrials and comparing them to look to see if goods are being moved, they may look to see if information is being moved at the same time at accelerating rates. And so let's compare, instead of to the transports, which is the traditional view, let's come up here to our comparison tool, and I'm going to compare to, did I not hit the transports? Did I still, hold on a second. Let me just double check something here. Yep, it's still comparing. This is not fair. Let's do transports first. I made a mistake there. Let's edit this. DJT, $DJT is the transports. There we go. Let's click OK and click Apply. Make sure that we're actually looking at industrials versus transports. So for example, there was an interesting period of time here where industrials were going up over a period of several months. What were transports doing? I knew there was something that looked a little bit different. Abdi says, can you chart also the difference between the two? That'd be interesting, right? To see if we're getting expansion, kind of like a Bollinger Band kind of an approach. But during this time, there might have been some Dow theorists that are saying, hold on, okay, never mind, now we're feeling a little bit better again. The transport's starting to recover. But I want to change this. Let's come up here. Let's change this from the transports to the, click Apply, click, no, I didn't do it again. Let's do that one more time. Anyway, the semiconductors, let's make sure that we have SOX in here. Click Apply, click OK. So this is a different comparison. Zoom in. Let's use our manual zoom. And we can do a click and drag right up here. There we go. So for some modern Dow theorists, they might look for industrials going up, and sometimes they might even do this with the S&P 500 or with a different index. But comparing that to semiconductors, which may help support the transportation of information around the world. And so like, for example, here in late 2024, industrials are climbing and climbing and climbing. What were semiconductors doing? They were in decline. For a theorist, that might have meant that there might be a bit of a pullback around the corner. So that's interesting. But that's how an analysis of that element of Dow theory might be performed. Now, finally, the theorist might be keeping an eye on volume. Does volume support their thesis? And with industrials on the rise, volume is still at least steady over time on average, and maybe even slightly climbing. So it still looks like a bullish confirmation. So as we're gathering technical evidence, and two things that we need to know about Dow theory is, number one, it's relatively complicated. Number two, it certainly can be in the eye of the beholder as well. There's a lot of discretion that can be applied here. But once the Dow theorist has established whether they're bullish or bearish, they remain with that outlook until a clear reversal. What does a clear reversal mean? Well, It could mean lower peaks and lower troughs over typically more than a 3-month time frame. And we're not really seeing that on either of these indices at this moment. So there's your introduction to the basic tenets of Dow theory. And what I want to do today is, let's say that our Dow theorist is bullish. And so therefore they're going to go ahead with whatever a technical approach they use to planning and placing a trade. So I'm going to use one of our previous technical approaches, the TVM strategy approach. And I've done a search already. Let me show you this. If we go over here to our live platform, I've created a scan. So let me load up our personal scans for our TVM strategy set. So here's this scan. If you're not familiar with our TVM strategy set, we talked about it a little bit earlier, but we're looking for a 50-period triangular moving average above the 100. We're looking for an RSI that has been down below 40 recently. We're looking for a MACD histogram that's below 0 but higher than it previously was. And we're looking for price to still be above that 200-period triangular moving average. So I put all of that into a scan here. I'll share this scan with you. Okay. So this is our TVM strategy. Let's share that. And I'll pop that into chat. And of course, shared scans are not guaranteed as to timing or accuracy, but when you get a shared link from a presenter, you can go up here, select Open Shared Item, and put that link right in there, preview, import. That'll put it into your live Thinkorswim platform. And then to run that scan, you just come to the Scan tab, and you would load that scan query. All right, but let's go place a trade. And the trade, well, actually, I'll show you this. Let's just run that scan through the component companies of the S&P 500. And I noticed that General Dynamics was one that popped up in this scan. And so here's General Dynamics on a chart. Looking at this, let's switch up our chart back to a candle chart. Let's go back to a 1-day view. And let's load up our TVM strategy set. There we go. So this is what General Dynamics looks like through the TVM strategy set, price just above that 200 or that 100 triangular moving average. The 50 is above the 100. Our RSI just dipped below 40 and started to rise. And our momentum indicator just ticked from bright red to dark red. Let's go enter a trade here. We have current positions here. We've been investing about $10,000. That's going to be about, one share. Let's see. How much is GD trading for right now? So one share, 348 bucks. Looks like we could get maybe 30 shares for our $10,000. Let's right click. Actually, let's just click. Let's put in quick market order to buy 30 shares. There we go. Buying 30 shares of GD. About a $10,000 investment. Let's send that order off. We'll talk about the management of that trade in future videos and webcasts. But guys, we've accomplished what I set out to do today. Today, I just wanted to use Dow theory as a technical framework, actually for the modern chartist, for analyzing trends of the current market. So I think this is going to be new to a lot of you. It might be one that you want to go back and revisit in the archives, which brings me to the point that if you haven't subscribed to our Trader Talks channel yet, do that right now. You can pop down below the video, click on the subscribe button. But our Trader Talks channel is where you can join the live streams and you can find playlists of previous webcasts. You can also, we certainly invite you to follow us on social media. You can find Kevin and me on X. You can find Kevin on X at Kevin Horner CS. You can find me on X at Cameron May CS. And I'm active here. When I post on X, if you reply to one of my posts, I try to reply right back to you. But you'll see right here was the question that created this discussion. Rachel had posted this, hey, Dow theory in full effect with the Dow Jones transports reaching new all-time highs yet again. And I asked, hey, question from my ex-friends, are you familiar with transports versus industrials Dow theory, or do you think I should maybe cover that? So we've covered it. So yeah, give me a follow on X. You can also follow me on LinkedIn. Just go to linkedin.com/in and then /Cameron May CS. And if you reply to my posts here, I reply to you as well. It's the only place to connect with me in between the live streams is on social media, so I'll look for you there. But we've done what I set out to do today. We've looked at our existing positions. We got some market context through that Dow theory lens, talked about what Dow theory is and then applied it to current conditions, looked at how for some traders and investors there's been that attempt to modernize. And then we even placed a trade using a familiar technical set of tools, but using also Dow theory as a backdrop for sort of the justification for the trade. We'll see if it works out. Grace, my pleasure. Everybody go have a great weekend. I will see you next week. I'll look for you in future webcasts. I'll also look for you on social media, but whenever I see you again, until that moment arrives, I want to wish the very best of luck. Happy trading. Bye-bye.